Welcome into our ETF.com webinar, Navigating Emerging Markets Amidst a Shifting Geopolitical Landscape, brought to you by MSCI and BlackRock. I'm Kristin Myers. I'm the editor-in-chief at ETF.com, and I'm really excited to be joined in this conversation today by Anil Rao, Executive Director of Equity Applied Research for MSCI, Jay Jacobs, Managing Director at BlackRock, and Kevin Wong, Vice President at BlackRock. We have a lot of ground to cover, so I'm going to just jump right into it. A lot to chat about here about emerging markets. But first, I want to do a little bit of scene setting with you guys. And Anil, I know that this is something that you can talk about quite a bit. I'm hoping if we can kind of just first start off for folks that are listening right now, how exactly would you even classify an emerging market? What really defines it?
Yeah, thanks, Kristin, and thanks for the invitation to speak today. I think this is a question that comes up a lot, which is just what is an emerging market? And there's probably a lot of intersecting themes that we can discuss today around risks and opportunities and about some of what it means to be active and some of the broader mega forces at work. But I always find it helpful just to step back as far as we can with a reminder on just what are the emerging market stocks, right? So today, as of August 2024, there are about 3,000 stocks with around $9 trillion in capitalization. So compare that to developed markets, which is around 5,500 stocks and around 75 trillion in capitalization. So about 35% of the opportunity set in terms of number of stocks, and about 10% of the market cap are classified within the emerging markets. So just wait a second, what is an emerging market, right? What is an emerging market? So we use three criteria, classify countries, to classify countries into developed markets or emerging markets, right? So the first is the level of economic development. The second is the size and liquidity of that market. And lastly, what is the market accessibility? Right? So what are things like currency conversion policies? Importantly, those criteria help, like I said, to kind of distinguish developed from emerging markets, but they also allow us to kind of track a single market, say EM or DM over time, right? So countries or even individual firms can join or exit a market. And that's a key consideration. We want the market, we want the index to be dynamic. So there are around 24 countries in the emerging market today. That's up from just a handful at the turn of the millennium, right? So it's really almost tripled in size.
So I know that you kind of mentioned that there's a couple of things that you think kind of help define and kind of hold together some of those, all of those emerging markets. Can you go a little bit more into some of those?
Sure. Maybe the way we could take this question is just what are some of the ways in which the EM index, the broad market, has changed over time, right? So let's again use that data or that time point that I raised earlier, which is the turn of the millennium. So what did the emerging markets index, what did the broad market look like 25 years ago, right? So back then, the five largest countries were Korea, South Africa, Taiwan, Brazil, and Mexico. Today, as we know, China and India stand atop the leaderboard, and Taiwan, Korea, and Brazil, notice those three persisted over time. Those three round out the top five, right? So it's China, India, Taiwan, Korea, Brazil today are the top five. Back then, turn of the millennium, there were around 2,000 stocks. I mentioned earlier, there's maybe 1,000 more now, so around 3,000 stocks in the broad market. But maybe the most telling data point is just how the sector makeup has changed. So 25 years ago, the emerging markets index was principally financials, it was telecom, and it was materials. Today, that sector makeup has shifted heavily. So it's still financials heavy, right? It's still financials heavy, but it's much more technology, less communications, and more consumer discretionary. So if someone were to tell me those facts alone, in my mind kind of align, in my view, with what my mind's narrative of what being in the emerging market today is. That is, phrases like capital market liberalization or the evolution from capital intensive, asset heavy to more asset light firms, the waxing and waning of China, the ascendance of India, it's kind of reflected in what I just described, which is the industry dynamic and then the country dynamic over the last 25 years.
So you were just talking a little bit about, right, that kind of growth and towards in the tech sector. Is that the most significant structural shift that you're really seeing that's impacting those emerging market indices right now? Or is there something else that also might be outside of tech that's kind of helping drive some of those changes?
Yeah, certainly the rise and growth of tech, and I know we're probably going to speak of that in more detail, some of the mega forces at work that's really behind that trend. I think the second most important characteristic of what's going on right now is just the ascendance of India, right? So India today, I think as of late August, it's almost neck and neck with China as the largest country. So they're each around 22, 21%. And that's been quite a rapid shift, quite a rapid growth in India just over the last 3 or 4 years. I would probably put those two trends, ascendance of India and ascendance of tech, really at the top of the major shifts.
You actually touched on something that we are going to go into a little bit more deeply, those mega forces. I've actually read a whole paper from BlackRock on that. And so I do want to get to that in just a couple of minutes. But just to kind of add a little bit more just context setting before we kind of talk a little bit further about some of the risks, some of the headwinds and tailwinds that are kind of facing emerging markets. I mean, what are you guys seeing right now with some of the implementation challenges, and really how are you seeing clients utilizing different vehicles to kind of help manage that portfolio efficiency within emerging markets?
Thanks, Kristin. I'm happy to touch on some of that. So, as a team who covers some of our largest institutional clients, we engage with pensions, foundations, endowments, consultants, and insurers who are responsible for some of the largest portfolios in the country. We're in a unique position to consult with these clients about what their biggest concerns and challenges are. Now, these clients have particularly been interested in what are peers doing when it comes to emerging markets, and what do they need to know when it comes to potentially separating China from the broader EM. Now, this has been a year of clients continuing to seek more granularity with their international EM exposures. We've seen that implemented through both regional and single country allocations, depending on the investor's view and objectives. And given the increased interest over the past few years, especially with trade tensions and sanctions related to China, we've done a lot of work to expand our product offerings. So that includes ETFs, commingled funds, and separately managed accounts for those clients who want a more customized exposure. We've noticed that clients who value immediate access to liquidity will typically gravitate towards the ETF wrapper, while clients who have specific mandates or prefer more customization have gone the commingled trust or SMA route. But despite the vehicle type, we've continued to see a trend of investors using a variety of regional, single country, style box, sectors, and factors to gain varying exposures to emerging markets. Now, when it comes to considerations around emerging markets, particularly ex-China, we see three main use cases, particularly with the institutional and wealth clients that we face off with. And so typically case one would be removing China altogether to completely avoid any potential geopolitical risks. We've seen this across state entities typically, who have been mandated to divest from China due to changes in state laws or regulations. Second, we see investors pair an emerging markets kind of ex-China exposure with a dedicated China fund to create a lever to efficiently add or reduce those desired exposures. Now, this approach has typically been adopted by those clients who may not have a particular strong view on broader EM or China, but they want to be able to have the tools in their portfolio to pull one of those levers if something does arise. And lastly, the third bucket, I'd say, this is the use case that we've probably seen the most within the past 6 months, is investors who utilize the EMX China exposure to underweight China in their index equities, and then give their active managers within EM or China broad discretion to determine if they want to overweight or underweight certain sectors or industries. Now, some of the other use cases that we've seen that don't really fit into those three buckets have been, some investors may feel they have enough exposure to China through maybe some other dedicated technology where they're analyzing the revenue generated from China. Some investors have gone a step further from removing just China and started to take into account removing Hong Kong from developed market exposures. We've also seen wealth platforms have approved broad EMX China, and dedicated China exposures to give their clients the optionality and flexibility with their model portfolios.
So you kind of touched on what we want to talk about next, which is actually risk, right? And as you were talking about some of those approaches and some of those approaches with EM in portfolio. So I guess I'm just kind of ask it straight up. What are the biggest risks that are facing emerging market investors right now?
Yeah, it's a good question. So I'd say it's been an exciting year for emerging markets, extending 2023's gains and returning 7.5% to start the first half of the year. But despite the positive gains, there are several potential risks that could impact these markets as we look ahead. Now, the key risks that are top of mind for the clients that we engage with and speak to are: 1, trajectory of interest rates and inflation; 2, election-related volatility; and 3, I'd say the potential for decelerating global growth, especially as it relates to China. So first, interest rates, which remain a critical concern for emerging markets.
Right.
The Fed's actions on US rates are especially important. Currently, markets are anticipating rate cuts beginning in September, with roughly 4 cuts expected by the end of the year. Now, these cuts could provide a much needed tailwind for emerging market economies, particularly those with currencies pegged to the US dollar, as local currencies would likely also appreciate. We also have to be mindful, though, any reversal in expectations for rate cuts could introduce downside risks. Inflation, although more controlled in developed economies, remains a sticky issue in emerging markets, especially outside of Taiwan and Turkey. Inflation has been persistent, driven by strong wage growth in the service sector. If inflation doesn't moderate, it could constrain the effectiveness of monetary easing and continue to apply pressure on emerging market economies. Second, geopolitical and election-related risks are really top of mind for investors. 2024 is a big year for global elections, with roughly 40 elections scheduled. That's going to impact 40% of the world's population. The potential for market volatility around these elections is definitely real, as we've already seen with recent elections in Mexico and India. Both countries experienced significant sell-offs immediately following unexpected election results, showing just how political uncertainty can drive market instability. Now, the US election also plays a significant role here. Emerging market economies are grappling with concerns about potential changes in US trade policies, tariffs, and geopolitical shifts. The possibility of a stronger US dollar resulting from these elections could add another layer of complexity for emerging markets, which would add even more uncertainty, even if the Fed cuts rates. And third, let's consider a broader global growth outlook. China still remains a source of uncertainty for EM markets more broadly. After a rebound to start the year, China's economic growth slowed quite a bit in the second quarter, and as you would have imagined, pulled down the full year's growth estimates. And the Chinese real estate sector has also been a particular drag with significant declines in investment. China's trajectory is likely to be tied to fiscal support, but with the PBOC taking a more cautious approach, the outlook remains uncertain. Now, for emerging markets, this slowdown in China's growth has some critical implications, especially for commodity demand. Countries that are heavily reliant on commodity exports could face increased risk if global demand weakens further. And while we believe it's unlikely we're headed for a US recession, it's clear growth is slowing, which could put pressure on EM. We recently took a look at some of the US consumer sector, which has shown mixed results, with companies like Amazon and Walmart reporting differing guidance on the health of the consumer. What is clear, though, is that there are signs of slack in the labor market with fewer jobs and unemployment rising. So as emerging markets have performed well so far in 2024, the three key risks that really lie ahead are, again, the trajectory of US interest rates and inflation, election-related volatility, and the potential for decelerating global growth, particularly in China.
Okay, so I want to drill down into some of those just a little bit more. Although I did see, Anil, you took yourself off mute. I would love to get you in on the conversation if you had something to add.
Yeah, sure thing. I just wanted to riff on one comment that Kevin had made earlier, which is around the broader trend in earnest of EM broad market toward more this separation of China and EM ex China. I think what we've heard from our clients is the trend of allocating to EM ex China. So one, that's paid off pretty handsomely, right? EM broad market, I think throughout the COVID era, throughout 2019, that's up around 10%. EM ex China, if I recall, is up around 30%, right? So that's been kind of a handsome bet that's paid off. But EM ex China actually raises its own risk in and of itself. That is, you're now more concentrated in certain sectors, particularly IT. You're obviously more concentrated in countries that have done well, Taiwan, Korea, India, but also even in single names, right? So that could be TSMC in Taiwan, Reliance in India, Samsung in Korea. Again, I'd say all of those risks have led to opportunities over the last 5 years. In the same vein that concentration in the US in the Magnificent Seven, Apple, NVIDIA, et cetera, that is a risk. It's a concentration risk, but that's actually paid off. But I just want to highlight that concentration risk is probably more acute in EM ex China than it is in the EM broad market.
Then I definitely want to dive into that a little bit more as throughout later in this conversation, especially as we kind of look even further out ahead. So as you were talking, Kevin, you kind of obviously, again, just kind of reminding everyone that you were talking about when it comes to some of these risks, looking at the inflation risks, the risks when it comes to geopolitically in terms of particularly elections. I do also want to talk, you did touch on currency risk as well. I want to drill down on that in just a moment. But in terms of the geopolitics, are the election risks the main risks geopolitically, or are there other risks that exist there when it comes to geopolitics that can impact investing in EM?
Yeah, so I can jump into that. Elections, I think, are a bit of a accelerant for broader geopolitical risk that we're seeing in the world today. And in fact, if you kind of zoom out, you look at recent history of going back to the global financial crisis, going back to COVID, to Brexit, to conflict in Eastern Europe, the conflict in the Middle East now, there's been kind of a rising tide of geopolitical risk. And in fact, BlackRock has a geopolitical risk dashboard, which shows that risks are high around the world. And there's really consequences to that I think we're going to see ultimately trickle down and impact emerging markets across three fronts. So I would say, one front is looking at the technology space. So we may have been in somewhat of a golden period over the last decade or two, where the rise of information technology led to a much more connected world. You saw, in a lot of ways, tech companies in the United States have made a lot of money overseas. In fact, 60% of the revenue of tech companies in the US comes from outside the US. So the biggest beneficiary of globalization from a sector perspective has been tech. And yet now we're seeing more fragmentation along tech fault lines. You're seeing between the US, between Europe, between the East, that really critical technologies like artificial intelligence or electric vehicles are increasingly in competition with each other. So this isn't so much about a globalization story. This is about national champions in different countries competing for tech dominance as we see how important and powerful these technologies become. So I think, one lens we have to look at this is what is the geopolitical risk of the tech sector globally for some of our Mag 7 companies in the US and for other companies outside the US. Second area where we're seeing geopolitical risk materialize is in supply chains. So, again, going back to, early 2000s, the mantra for a lot of supply chains was, where do we get the cheapest possible inputs? And often that was looking to emerging markets for raw materials. That was looking to emerging markets for manufacturing and ultimately shipping that to developed markets for consumption. COVID really highlighted some of the challenges with that, which is when you have geographical breakdowns, when you have shipping lanes that are either clogged or there's a ship blocking a canal, or if you just simply have more geopolitical tension between two countries, that reliance on overseas materials and manufacturing can actually be very risky. So the mantra now in a lot of supply chains is about resilience, not just about low cost. Resilience can mean building things in your domestic home market through reshoring. It can be building things close to your home market with nearshoring. As we've seen, countries like Mexico have become, the biggest trade partner of the United States. And it can mean what we also like to call friendshoring, which is just choosing your trade partners wisely, including ones that maybe have more affinity towards the West or towards developed markets. So supply chains are really shifting amongst this geopolitical environment. And then finally, I'd say, the third one is just the risk of more geopolitical conflict. That can take place in wars, that can take place in cybersecurity. But as you see tensions arise, unfortunately, those tensions can ultimately materialize into real impact. And, we're certainly seeing that right now on a couple fronts across the world. And that can ultimately impact things like supply chains and trade tariffs and retaliatory measures. So, the fact that geopolitical risk is on the rise, unfortunately does mean that there could be more, kind of general war and cyber attack risk around the world today.
Is there one geopolitical risk that you think might be kind of outweighing some of the others?
Well, I think the most consequential that we're seeing right now is probably around supply chains. To put a little bit of color around this, simply a semiconductor that has to go through manufacturing to being put in your iPhone can cross about 70 borders from the beginning to the end of that process. So you can imagine one of those borders being shut down, being tied up, having new tariffs applied to it. Can really challenge one of the most critical ingredients in our digital economy, which is semiconductors. So, there's a lot of action around that. That's why we're seeing things like reshoring. We're seeing policies out of Washington, like the Chips and Science Act and the Infrastructure Investments and Jobs Act, to really try to build more robust supply chains. But the economy is still really dependent on globalized supply chains. And I think to the extent that those are further disrupted, it's going to be expensive. It's going to be contributing to inflation, and ultimately could mean that it slows economic growth.
So we've obviously drilled down a bit into some of those geopolitical risks. I kind of want to jump back to currency. I think this is something that, at least for our investors here, is something that they've thought about, obviously, very recently over the last couple of weeks, currency issues and how they've been impacting the market. So obviously we have a couple of issues here. It comes to dollar strength. We've already talked a little bit about like elections. How are these things impacting currencies inside of these emerging markets?
Yeah, thanks, Kristin, for the question. If I could just take a stab at this, and then I'll pass over to my BlackRock colleagues as well. So I'll respond with a question back to you, and I know that's not normally how things go, but what do we know empirically about the emerging markets? So one fact we know is the country that a firm is domiciled in drives a large part of its risk. That's not the case in developed markets like Europe and the US, where the industry that a firm is in, the microeconomics of that industry, that's the predominant risk. And I know the title of this webinar is Geopolitical Risk in EM, but I just want to make note that political risk and country risk has always been the norm in EM. It's always been the norm. That could mean institutional risk, the strength of the judicial system, the governance effectiveness, or just the willingness and ability of the sovereign to service its debt, right? So we have a term for this. We have a quantitative term for this. It's called cross-sectional volatility due to country. All that means is country drives a large fraction of a firm's volatility, and that's important. Now, it turns out that post-COVID, there are a few notable changes, right? There are a few notable changes over the last 4 years. One is that country dispersion is wider. The extremes in country returns, and I know Kevin had spoken to this very briefly, those extremes in country returns is wider today than it was pre-COVID. The brightest example of this is, of course, China. It's down around 5% over the last 5 years, whereas Taiwan and India, I think we had talked about earlier, they're up around 20% annually each. But intimately linked with country risk is, as you mentioned, currency risk, right? So what do we know about currency risk throughout the COVID era? What do we know since 2019 about currency risk? Well, over the last 5 years, the Brazilian real, the Korean won, the South African rand, those have all fallen against the dollars, while the Mexican peso, despite this year's fall, pardon me, that's gained slightly. But that's return, that's not risk. Risk accounts for both the up and down movements. Some months, the foreign exposure might work with you, it might work against you in another month. But the risk of that is constant. And foreign exposure, foreign currency exposure in emerging markets has historically accounted for about 20% of the total risk in an equity portfolio. That's for a dollar-based investor. For a Canadian dollar-based investor, that's around 15%. But since rate hikes began, right, in 2021, which of course has whipsawed central bank policies around the world and subsequently whipsawed emerging economies, the risk of currency exposure has gone up materially for U.S. investors, right? But that's also true. I'd say that's just kind of writ large, that for a U.S. dollar investor in EFA, for example, which is principally Japan and Europe, that risk of foreign currency exposure has gone up as well. That's spiked. So historically, that's counted for around 10% of total risk in late 2021. That's now around 25% of risk in EFA. So that's actually very interesting to me, which is if you're a dollar investor in the emerging markets, your currency risk is high, but it's actually about as high as a dollar investor in EFA right now. That just shows you kind of the effect of some of the yen volatility. So that, that flip-flopping, pardon me, of EFA in EM, I think is a notable data point.
Kevin, Jay, anything to add there, especially around currency risk?
Nothing for me. I think Anil nailed it there.
All right, so we've talked a bit at length, a little bit about, the risks and the context setting. I kind of want to move ahead to some of those investment approaches, especially active management, right? Active in general has been something that has been increasingly interesting to a lot of investors, regardless of where they're what they're investing in. But I want to talk about that wrapper, right? How is that in EM, right? How has that really evolved with some of these new approaches?
I can take a first step at this one, Kristin. So I actually took a look at some of the active EM space yesterday, and looking at the number of funds launched since 2019, there's been about 68 active kind of ETF and mutual fund strategies launched within the broad EM space. Now, that compares against 21 index type exposures within EM, and that's across both ETFs and mutual funds. So while the trend has been more active launches in the space, you'd be surprised, or maybe not surprised, that the flows don't necessarily represent the amount of active strategies that we've seen launched. So just to give you an idea, since 2019, those 68 or so strategies that have been launched. Now, that's it. That's more than 3 times the amount of index type strategies being launched with EM. But all of the active strategies within EM since 2019 have taken in about 5 billion of inflows. While that is a good and impressive amount, the amount of flows that we've seen into index EM strategies has been quite staggering. It's been 461 billion of inflows into index EM strategies. Now, quite a difference from the 5 billion into active strategies. So while we do see more launches within the active space, I think it's becoming increasingly challenging for these active managers to attract assets. Looking at some of the performance now, just a single snapshot in time, year-to-date performance, the average active fund within the space, about 50% of those active managers outperformed kind of the broad EM benchmark. And so I think investors are looking at the costs associated with some of these active strategies. And so the average cost for an active strategy within EM is about 94 basis points. Now that's compared to the index costs, about 42 basis points. So I think investors are really looking at the performance within this space and evaluating if paying this increased costs for active strategies within EM is worth kind of the performance that you may or may not see. And just simply looking at the average 2024 returns for an active strategy within EM is about 7%. That's compared to the broad EM benchmark about 7.5%. So I think all of these considerations around performance, price, tax efficiency are really impacting the investor decision whether to go index or active. And as we've seen by the flows, I think the trend has been to utilize some type of index strategy within EM.
I do think, building on that, Kevin, there's different flavors of active, and I think a storyline the industry is probably overly fixated on is index or active, and I think one of the ways that we're seeing this play out is index and active, which is there's some portions of EM that maybe you want to take with an index approach and then apply active as an overlay or active to specific areas. We've seen some people maybe do an EMX China approach for a benchmark and take a more active approach to China specifically. Other ways that we've seen it is being active with allocations within EM, whether that's kind of a country rotation approach, upweighting certain countries, like we were just talking about reshoring and friendshoring. We've seen some significant flows into countries like India recently as a beneficiary of that friendshoring approach. And so there's kind of a strategic upweight. We've also, Kevin, you were pointing out EMXC. One of the ways that you could think about kind of in emerging markets like China exposure is by, kind of the uplift that gives to countries beyond China and tactically overweighting those countries. So I think there's different flavors of active. There's certainly the stock picking approach, but you can be combining index and active or simply kind of using index exposures as a way to be active in your portfolio, but through index implementation.
So then, Jay, just kind of sticking with you for a second, you kind of mentioned some of them a little bit, like just the different flavors that exist out there. I think you said single country, you threw out as one of them. Are there other kind of key considerations when investors are kind of taking some of these approaches in EM that they should really be thinking about? And what are they? Could you drill down onto those a little bit more?
Well, I think part of the appeal, and Neil will know this as well as anyone, is the dispersion between single countries within the EM space. There's some real idiosyncratic risks and opportunities among them. So if you are, looking to become a single country allocator or regional allocator, that can drive a big source of alpha because of that dispersion. Now you have to get your bets right and your timing right to do so. But if you can try to harness some of the long-term structural trends that we've mentioned here around geopolitics or supply chains, being tactical with those exposures and kind of being smart about upweighting the right countries amongst that dispersion can really drive outsized performance.
And so speaking about some of that outsized performance, because again, as I mentioned at the start of this, I was reading a paper or guide, whatever we want to call it, from BlackRock actually around mega forces as really an investment opportunity. I don't want to be the one to lay them out. I'm hoping Jay or Kevin, you might be able to talk a little bit about what those mega forces are.
Mega forces are really long-term structural themes that are, upending major swaths of the global economy. This is an area that we've been looking at since 2016. We previously called these mega trends, and we had identified 5 mega trends that fit the bill. But last year we took a fresh look at it, and I think we made a couple of changes. One is, in a post-COVID world, those 5 mega trends had changed, and so I can go through those 5. But on another layer, we started calling them mega forces because we realized that whether you are intentionally allocating to these mega forces or not, they will impact your portfolio. They really are these forces that are going to impact everything from fixed income to equities to alternatives, and really be felt in a lot of different ways. And so our 5 mega forces today are digital disruption and artificial intelligence, a transition to a net zero economy, demographics or demographic diversion, which is really about kind of youthful populations in emerging markets versus more aging populations in developed markets. It's geopolitical fragmentation, which we've talked a lot about, the rising geopolitical risks around the world. And then finally, it's the future of finance and how things like digital assets and alternatives are playing an increasingly important role in our financial system today. We've talked a lot about geopolitical risk, so maybe we can kind of skip past that one. But I think one of these mega forces that is so applicable to emerging markets today is demographic divergence. When you look at the developed markets, United States, Europe, these populations are getting older. In the United States this year, for the first time, we have more people over the age of 65 than under the age of 15. We like to say it, more grandpas than grandkids. And that's a challenge for developed societies. That means shrinking workforces. We added about 20 million jobs over the last 10 years in the United States. We're probably only going to add about 4 million in the next 10 years. So slowing workforce growth. Slowing workforce growth can be, can lead to less economic growth. It can lead to inflation because you have fewer people competing for jobs. So there's more pressure from workers to demand higher wages. And also there's a kind of economic burden on governments of aging populations, which is the healthcare needs of individuals over the age of 65 as well. So it paints a bit of a challenging economic picture to have aging populations. Now, if you look to emerging markets, and particularly emerging markets beyond China, you see a much more attractive demographic picture, much more youthful, growing workforces, upskilling of labor as well as those labor forces mature. That can also lead to growing consumerism because as you have a growing workforce, you have more people with more money that can buy more things. All of this ultimately tends to contribute to more economic growth. So if we look at India, for example, 65% of the country is under the age of 35, and about half of the country is under the age of 25. So you really have a huge base of youthfulness in India that is going to be entering the workforce and getting jobs and consuming more and ultimately driving economic growth in India such that likely in the next few years, India will become the 3rd largest economy, surpassing Japan and Germany. And demographics is really playing a huge part in driving that growth. What that means for some of the other topics we've talked about is what does this mean for supply chains? As we choose our reshoring, nearshoring, friendshoring partners, if you're making a long-term bet on the supply chain, because these things are expensive and take time to develop, it might make sense for companies and governments to really focus on those youthful populations. So I think it's no surprise that, again, Mexico has really emerged as a big winner so far in changing supply chains through that nearshoring story. So close to the U.S., free trade with USMCA, and a youthful population. All of that adds together to be a pretty attractive trade partner. But also India has been a big beneficiary. And so you've seen significant efforts by the Indian government to support more manufacturing. You've seen their own kind of Chips and Science Act to invest in semiconductor development in India. You've seen major corporations in the United States shift supply chains towards India. You've seen a repeal of some tariffs between the US and India. So again, demographics can really be a powerful long-term driver in these countries and materialize in some really impactful changes around things like supply chains and economic opportunity.
So, Jay, are you seeing some of these demographic changes as opportunity broadly across EM, or do you see it as opportunity in some and risk in others?
I would say opportunity in most, not all. If you look at China versus broader EM, China famously has an aging population as well. But then you start looking beyond China. I would also put countries like South Korea in kind of the aging population bucket as well. But some of these really large population countries like India and Mexico and beyond tend to have much more attractive demographics. So I think on one hand, again, looking at emerging markets like China as kind of a baseline exposure is a good way to kind of uplift your allocation to attractive demographics. I do think people who are really investing for the long term, though, this isn't just a question of how you're investing within EM. I think this is actually a question of what is your split between developed markets and emerging markets. It might make sense if you're trying to lean towards long-term economic growers to upweight emerging markets. Frankly, that's not something we've seen so much recently. We've seen a lot of, financial advisors in the United States at market neutral or even underweighting EM relative to benchmark. But again, for growthy, more aggressive portfolios, it might make sense to really try to harness this demographic tailwind.
Speaking about tailwinds, you've brought us right into our next topic, is really kind of looking out to the future. So I kind of want to throw this out. I know Kevin and Jay, you might have a couple of thoughts here, and I want to drill down even further into some of the sector and industry kind of tailwinds. But what are you seeing broadly as some key tailwinds that is facing emerging markets end of 2024 into 2025, and perhaps even beyond, that investors should really be paying attention to?
I can start. I'm sure we all have some interesting ideas around some of these future tailwinds. I mean, I think, the story of the year is artificial intelligence, and that is one of our mega forces. So I do think we have to acknowledge that this is a mega force that is playing out in real time and might have an impact on emerging markets as well. If in a lot of ways, artificial intelligence is a story of automation to make people more productive. It is a tool that can increase output no matter where it's being used. So if you look at it in the context of either trying to get lower cost labor in emerging markets versus automating through technology, the better technology gets, that could be a more negative tailwind for emerging markets. However, at the same time, I don't know if that's necessarily going to be the case. You do see that emerging markets are, in many ways, material exporters that are going to be used in things like semiconductors and digital infrastructure. As you see more consumption in emerging markets, you see more digitalization and more digital participation. That's creating more data in emerging markets, and artificial intelligence makes data more valuable. So what we could see is more digitalization within emerging markets as well, and effectively a leapfrogging effect where countries that previously didn't have a ton of capital can grow very quickly because they're going to be able to tap into some really powerful technologies really early in their development cycle. So I think there's some pros and cons to artificial intelligence in the context of emerging markets. I do think you really have to look across the artificial intelligence supply chain to see how that might impact EMs, but it is certainly a megaforce to keep an eye on in the context of EM.
Go ahead, Anil.
Yeah, just to comment on tailwinds, and I'll try not to make any forecasts here, but I do think a lot about kind of what the components of return for a stock or a portfolio are. And that's really comes down to just a handful of things. It's earnings growth, right? Is the firm growing their earnings? 2, is it paying dividends? 3rd is currency, which we talked a little bit about. And then the 4th is what happens with the multiple, right? Does the earnings multiple expand or does it compress? So here's an interesting data point. Pre-COVID to today, think of all the things that Jay and Kevin have just mentioned, the reconfigurations in supply chains, persistent inflation, rate hikes, and even now, most recently, the build out of these specialized semiconductor supply chains. EM countries today, in large part, are trading cheaper than they were pre-COVID. In fact, 19, I just saw this the other day, 19 of the 24 countries in the broad market are at a lower multiple than they were in December 2019. So again, I'm not trying to make any forecasts here, but the fact that so many of the countries are kind of primed for valuation expansion, or I'd say at least trading at a lower multiple, and given that valuation expansion is a key component of return, that could be a potential tailwind.
Kevin or Jay, I don't know if I know that we were kind of talking a little bit, before all of this, that valuation was one of those kind of key future tailwinds. I don't know if either one of you wanted to comment just a little bit further on what Anil was saying, giving us some of that more historical context in terms of what you guys are seeing in terms of valuations looking out into 2025.
I mean, that's certainly a potential tailwind, right? I mean, Anil covered it with, the fact that, you can see some richness in developed markets versus less expensive valuations in EMs. I mean, if there is some sort of retracement to baseline, I think that would be a very positive tailwind for emerging markets. So, if people have a value tilt, I think they could certainly be overweighting emerging markets as well.
I actually am curious to know, I kind of wanted to go back to what you were just talking about when it comes to AI. And Kevin, I'm not sure if you had some thoughts particularly on that theme there. You were mentioning it not just as a potential tailwind, but in some instances, a potential headwind. Could you expand on that just a little bit more?
Yeah, so if you look at artificial intelligence as a tailwind, I think you really have to think about kind of which parts of the economy are going to benefit from growth in artificial intelligence. Some of the areas that we've identified in particular are areas like healthcare, where drug development could get less expensive, and therefore drugs could ultimately get cheaper. I think that's something that would benefit kind of all of society. We've looked at things like legal, consulting, programming. Design. A lot of services could potentially get cheaper and more efficient as well, which could ultimately have benefits for broader society too. But I think the important thing is any sector that's going to get more efficient, you really have to think about kind of upskilling that labor as well. One interesting dynamic that I would point out is if we go back 6 years ago, I think there was a view that if you divide, artificial intelligence into really two pieces, AI, the software, and AI in terms of automation, which is really kind of the physical manifestation of AI through robotics, the software side has grown a lot faster. And that's actually a very good sign for emerging markets, because that means low-cost, labor-intensive industries really have not experienced that much automation thus far. Doesn't mean it can't happen in the future, but the software side of things, generative AI, have really taken off with the growth of ChatGPT, with Claude, with Llama. All these different models have really started to automate services much more than raw labor input. So yes, there could be tailwinds and headwinds, but I do think what's interesting is really kind of how Gen AI has moved forward ahead of robotics as a fast-growing space, and that's probably a positive for EMs.
And Kevin, I want to give you a chance here just because I did see you come off mute. And so I'd love to get some of your thoughts as well.
Ooh, I don't know if I have anything for this one.
No, it's fine. You definitely heard Jay kind of cover it pretty well. Wanted to throw out to you guys as well some other potential headwinds that might exist out there. I know that we talked about some of the risks that were impacting the EM space kind of more broadly, but are there any more short-term risks or really headwinds that you guys are seeing more towards the end of the year into 2025, or is it really just a ton of upside for EM investors?
I think as I mentioned early on, Kristin, there's a confluence of different factors that are impacting the outlook of EM. While we do have kind of interest rate risk within the US, that will dictate a lot of impact on EM currencies. As I mentioned before, a lot of unexpected election results could definitely have the opposite effect of what those lowering of those interest rates will have on some of those EM currencies. So I wouldn't say that there is one particular factor that is going to impact how emerging markets are going to be impacted heading into next year, but it's just a multitude of different factors, as I mentioned before, that make the outlook a little bit unclear at this point in time.
I'm actually wanting to kind of go back just as we're talking, looking out ahead, because everyone has kind of mentioned it a couple of times throughout this conversation about, EMX China and where you guys really see that trend going next year, especially since EM has been so responsive to growth in that region. What you guys are anticipating for EMX China really in just the next year, considering some of these factors that we've seen just even recently when it comes to China's economy?
I think Kevin did a good job kind of laying out the different cases for it. I mean, I think first of all, we are going to see a growing amount of investors that simply just want to bifurcate EM between China and emerging markets ex-China. That might just be to manage risk. That might be to manage kind of growth opportunities. But I do think this is going to be a growing trend as people look to, essentially treat China the way that they treated Japan in the 80s and really carved out, an exposure to Japan versus the broader APAC region. So I think that's just kind of an investor trend that's going to grow in popularity. For the several tailwinds that we talked about, I do think we're going to see more strategic upweighting of emerging markets ex-China, whether that's a supply chain story, whether that's a demographic story, whether that's kind of a combination of both. I do think we're going to see kind of more thematic views around emerging markets ex-China evolve. But we did talk a bit about valuations, and one country that is very inexpensive from a valuation perspective is China. So I do think something to keep an eye out is if we do end up in more of a value-y market, we could see more kind of single country exposure to China. So we don't have a crystal ball here, but I do think we can project some of the trends that we've seen this year continuing based off of client conversations and our own research on the space around mega forces.
And Neil, I wasn't sure if you had something to add to that.
I was just going to add to Jay's comments that EMX China appears to kind of occupy a lot of media share and mind share right now. And we talked about some of the risks as well. So, just as the U.S. right now, I think a lot of the conversation is, look, the U.S. is a very top-heavy market, right? We've been hearing that, going on 18 months now. We know the reasons why. It's these Super 7 stocks, or Super 6, I guess, if you count Tesla or not. And I think at last read in the U.S., those, the top 10 stocks account for, let's call it roughly 30% of the market capitalization, right? And that's at historic highs. Within EM broad and even within EM ex-China, it's about the same. We don't talk about it as much. We don't hear about it as much, but there are a few number of stocks that are driving a large fraction of the overall market's return. That might sound anomalous, but that's actually always been the case at EM. 10 years ago, it was the Chinese tech firms, Tencent, Alibaba. Today, maybe it's shifted a little bit toward, as I said, Reliance, in India, Samsung, or TSMC. I view that as really kind of risk and opportunity all wrapped up into one. The fact that it's a top-heavy market right now has been a tailwind. It could turn right into a headwind as well.
Well, I know we're essentially pretty much at time right now. I kind of just wanted to ask one nice last question to you all. If you do have any kind of a final thought that you really wanted to leave everyone with as they're kind of approaching EM, thinking about it in their portfolios as they're thinking about EM out ahead, I kind of want to just go around the room. I think I'll maybe start with Kevin. Any final thoughts that you guys might have?
Yeah, I would say with the proliferation of different active and index products that we've seen come to market, I think investors are increasingly looking for creative ways to gain exposure to emerging markets. Like I mentioned, I think we've seen investors look for obvious ones are single countries and regions, but looking more into the sectors or the factors or the style boxes. Now, there hasn't been as much interest historically, but as the market has evolved, especially within ETFs, we've started to see more providers start to launch different exposures in the space to gain access to either some of these themes that Jay had touched on earlier or revenue exposures. And so I think the market is continuing to evolve as investors have the appetite to kind of break out EM in new ways.
All right, let's go over to you, Jay.
Yeah, I would just say that we've had a major step change in EM. This is not the same EM as 5 or 10 years ago, in terms of the demographics, in terms of the political scenarios that are playing out there, the trade relationships. It looks very different. And so for advisors out there that are looking at their EM position, I don't think that necessarily the approach that they took 5 years ago makes sense for the next 5 years. Maybe it can be re-underwrote, but looking at your allocation, looking at how you're getting exposure to EM, whether it makes sense to get more granular through, an emerging markets like China approach or upweighting certain single countries, I do think it is the time for advisors to take a fresh look at the space.
And Anil, you've got the last word.
Yeah, thank you for that. I think my final comments are just, what does it mean to be active? And I think about the revolution and that the ETF has provided, and what that has allowed investors like myself, an individual, to do is to be active through country picking, regional picking, style picking. And there's many ways to be active, but to use index rules-based products. Thank you.
All right. Well, I would love to thank my 3 guests, Anil Rao from MSCI, Kevin Wong from BlackRock, and Jay Jacobs, also from BlackRock. And thank you all so much for tuning in to this webinar. Now, if you missed part of the conversation or you just want to watch it again and again and again, you will be able to catch the on-demand version at ETF.com. Thanks so much.